An idea. Welcome back to Alberta Primetime and the Vocal Point panel on money. Could we be underestimating oil production in Alberta? One CIBC report is saying predictions are too conservative. And if Alberta crude does eventually flow through a Northern Gateway pipeline, will it find a refinery on the other end? A BC newspaper tycoon is hopeful that will be the case. Here to talk about this and more, Russell Dratwa, an investment advisor with Canaccord Wealth Management in Calgary, Shafik Hirani, Director with Investors Group Calgary, and Beth Hamilton-Keene, Director and Portfolio Manager with Moore Investment Management. Good evening, everyone.
Hello, Brenda.
Hello.
Well, let's start first of all. When you hear the CIBC World Market, Shafik, report that production of North American crude could grow as much as $900,000 a barrel within 5 years, what do you think? To me, it sounds good. Is there a downside?
Well, there's a couple of downsides. I mean, the report CIBC put out is about 250 pages, and what it does is it contradicts a lot of the existing estimates about the amount of oil supply that we're expecting. They expect oil production to rise by 10% per year. So right now, annually, we're exporting 1.6 million barrels a day. They're expecting it to go up by 100,000 barrels per day. The concerns on the other side are who's going to buy this stuff. We have to ship it down to Oklahoma. There's no refinement. The pipelines aren't set. The train companies are all going, well, wait a minute, we can ship it down for you. So it's a little bit comical in a sense that we haven't really moved as to who's going to buy the actual oil itself.
What do you think, Beth?
Well, certainly the whole equation of supply and demand and the imbalance that has been growing in that way certainly comes to mind, and caution is required here. We have to watch the cost of production as well as the overall commodity prices as you see supply continue to come on the market. You can't necessarily expect the higher prices that we've been seeing in the last 12 and 18 months. There is this general expectation as this imbalance continues that you'll see prices begin to come down. So that all comes into place, and the other big headwind there is really the worry about transportation and refinement, and we're at capacity. How can we possibly finally get it to the end user?
So what's all this? What kind of effect is it going to have on energy stocks, Russ?
Forecasts are always open for debate, I mean, on both sides of the spectrum. The bottom line is I look at a 5-year average of the weekly inventory numbers, and we're well above the 5-year average right now. Oil prices have gone up 25% in the last 6 weeks. So the supply is there, and yet the price is high. So, I mean, that tells me that if you're an active trader, you might want to consider looking at your oil positions, perhaps trim going into a very difficult time. Sometimes August, September, and October can be in the marketplace. And if you're passive, make sure you have high-quality companies, look at dividends, things of that nature. But 23% in the past 6 weeks, I'm sure most portfolios out there are not up 23%.
Shafik, I'd like to return to something you said too. How does it add to the importance of a pipeline that transports bitumen out of the province to Asian markets? I mean, we're referring here to a potential glut.
Yeah, there's definitely a big bottleneck. I mean, we built the development in the oil sands. However, we have to export it. And there's a lot of debates over the Keystone pipelines, the Trans-Canada pipelines, Enbridge's Northern Gateway pipeline. If we can't get the right pipelines in place, then we have to ship it by train. And there's a lot of feedback and conflict from the BC Premier saying, well, we want more than 9% royalty. So we need some kind of export facility as well as, like Beth said, some kind of refinement facility.
Speaking of refinement facility there, Beth, a BC newspaper mogul, David Black, has proposed a $13 billion one for Kitimat. How logical is that idea for the end of a pipeline?
Well, certainly it makes sense on paper. It's just going to be a matter of getting all the right parties on board and getting all the right contributors in place. And I think that'll be the stretch for the near term. The hard part here is it's spending money, and who is going to kind of make those strategic decisions and really make that large investment that it's required. Of course, not just on a financial standpoint, but also on a political standpoint as well. So those are all be interesting pieces to watch as things unfold.
Well, if it's such a good idea, why has no one else thought of it, Russ?
There hasn't been a refinery, I believe, built in North America since 1984. The costs are absurd, and then you're dealing with environmentalists, not in my backyard. So it's going to be interesting if it's a lot of people. I had somebody indicate something that this is sort of a switch and bait just to increase the railway to take this. But I talked to one individual in the pipeline industry. He said this gateway is happening no matter what, even if they have to swing up. He said to the Northwest Territories and Yukon. I thought that was pretty interesting. He said it's going to happen.
If a pipeline does happen, Shafik, what are your thoughts about a refinery at the end?
You know what? I don't think it's a pipe dream. It ain't going to happen. You know, the idea is great from the guy that came up with it is a newspaper mogul in BC, and he's talking about a $6 billion project. The infrastructure to go into an approval of the project itself is 3 years' time. And if we're exporting 1 million barrels a day by a pipeline, to get it down there, by then it'll be 2 million barrels a day. And that in itself is just a 3-year approval process. The framework just isn't there to create it yet.
Okay, next, the inflation rate is in and it's lower than expected. What effect might that have on our inflation? Our Monday Money panel is back with their thoughts and what's on their radar right after the break. Welcome back. Inflation numbers released by Statistics Canada came in at only 1.3%, and in Alberta we fared even better at 0.9%. Shafik, the question we always have, what does this mean for interest rates?
You know, this means that interest rates might not be going up anytime soon. Mark Carney, the governor of the Bank of Canada, is speaking at the Canadian Auto Workers in the East next week. He's going to have some tough questions to field, but you're going to see the Canadian dollar rise and the deferral of interest rates down the road even further than we originally thought.
Beth, why is inflation lower than expected, do you figure?
Well, part of it is just that kind of tepid overall economic climate. So, you know, the 2 steps forward, 1 step back. A lot of this had been predicted for quite some time. And of course, with the European worries, that also contributes to the uncertainty that's out there. So you're not seeing a lot of growth, a lot of business and investment and activity across all sectors. So that's a part of it. Obviously, as we look at kind of what's inside, no big surprise. I'm sure most Albertans have seen it. Food inflation is a big contributor. And that's not just an Alberta problem. That's a global problem that we'll continue to watch.
So any downside, Russ, or is this just money in our pockets?
Well, the downside is it's putting the conservative investor further out on the limb looking for better returns to supplement their incomes at retirement and such. I mean, interest rates are at 30-year lows, so where do you get the returns? And we're going to touch on that briefly.
What's your advice?
There is an upside, however. The upside is you don't have to worry about paying off that mortgage quite as quickly. The pressure isn't as hard.
You're always watching the shaky markets, though, Russ. So what's new for investors out there?
Well, it's such an interesting dichotomy. We have the conservative investor doing very well with their dividend investments and the aggressive investor getting hammered by the markets. And yet we have to equate the markets to corporate profitability. That's the essence of the marketplace. And we have record corporate profits, margins, record cash on hand. So from a Puritan standpoint, it's a great time to invest, but it's like a calm water, and you have these huge rocks called Europe, slowing China, and U.S. pending debt that we have to deal with. So steer carefully, but one analyst said the markets have never been this appealing since the 50s. But again, there's some pretty big rocks ahead.
Shafik?
Yeah, Russ is right. I mean, we're kind of cautiously optimistic right now at this current relief rally. Doesn't seem to have the respect that the past rallies have had. The opportunity, like Russ mentioned, is in terms of the price of the markets towards the earnings valuation. It seems like a good opportunity. However, how legitimate are the earnings? So you want to make sure you're well diversified, and you want to make sure you have a written plan going forward.
I mean, we've been hearing a lot about Canadian pensions being hard hit by the continuing European concerns. Is this long-term pension reality, do you figure, Shafik?
Yeah, you know, a lot of the pension plans are looking for alternative investments. So they're looking to the emerging markets. They're looking to the Latin America, Brazil. But the pensions themselves, like the big government pensions, they're in an underfunded liability situation. So there is a concern if you're a pensioner not to put all your eggs in one basket. What
about that Brazilian infrastructure, Beth? Risk, reward, little of both potentially here?
Well, certainly it has the potential to have both, and I think that with most pension plans in Canada, certainly the larger ones, have already been investing in infrastructure. This happens to have the appeal of not only infrastructure, but infrastructure in an emerging market that's quite interesting and tempting. I would say caution would still prevail, and really as you look at pensions around the world and Canada as well, we're really facing that age-old interest rates are not going to deliver, and fixed income is not going to deliver that same base return that you would expect conservative type pension plans to deliver. So they're being forced to look elsewhere, and they're also being forced to adjust expectations. And part of that is really what you're seeing in the underfunded status.
So any potential still in some of the social media stocks, Russ?
Though they're so overpriced, the vast majority, and how do you put fundamentals on them? The 500 U.S. largest companies represented by the S&P 500, their price to earnings is about 16 times what the companies are earning. And I believe Facebook was at 69, even with this decimation that the stock's gone through. The social media has had this huge influx of how do you monetize? How do you get advertisers to pay? How do you get anybody to pay for this?
Because, of course, Google sells things, but Facebook doesn't necessarily sell things.
Correct, not yet. It's the advertisers. And now what they've been is they've been blindsided by this huge exodus to the mobile. I mean, supposedly 1/3 of all information is transacted over the mobile now. So they've just been blindsided with, I don't know about you, but when you look at your little mobile unit, there's no advertising. Mm-hmm. That's the great thing about it. So they're trying to figure out, how do we monetize, and now how do we do it on these mobile units? That's the key. If you can figure that out, you can make a lot of money.
So what's going to happen to them?
They likely, the good companies will survive. The good companies always will. They will figure out a way to monetize this. They will figure a way to come through this. It happened in the tech bubble, and the best did come through. And the fringe ones, the ones that have the high debt, that will go the way of the dodo bird. They'll be merged and acquired by the larger, better corporations. Cash is king on the books.
Every year, The Economist comes out with their list of most livable cities, and Canada had not one, not two, but 3 cities in the top 5, including Calgary at position number 5. Beth, good news or to be expected?
Well, it's wonderful news. Anytime that we can be put on the map for positive things, I would say that's a very good thing. In fact, as I travel globally with some of my work with CFA Institute, the oil and gas burden tends to kind of wear thin after a while. So it's pretty good news to be on the list for some positive things.
Shafik, Edmonton isn't even mentioned.
Yeah, I noticed
Cause
that.
for concern, or because Calgary's on the list, Alberta is not far behind?
Yeah, we're Calgary. We share our award with Edmonton at all times, so we're happy that Edmonton's going to be on there next year.
Well, how do you feel about it?
I doth protest. We're not even on the list. I mean, they haven't even looked at us because they said it's either Calgary or Edmonton, and for proximity, they looked at Calgary. So, to me, I mean, Edmonton's all about the people. Calgary's got the corporate advantage. Edmonton's got the government advantage. So, like Shafik said, they need that unirail to make us basically one entity and put a dome over all of us, and all is good.
I'm just wondering if we have 3 Canadian cities on that top 5, ladies and gentlemen. I mean, does that mean it's because of our economic strength? What's it because of?
Without a doubt, and in Alberta, it's our resource sector, and so without a doubt, we're very fortunate.
Beth? Yes. What are your thoughts on that? Is it because of our resource sector?
I would say it's a combination of everything. Certainly financially, if you look kind of globally, we're high respected, and certainly the way we pulled through the debt crisis and continue to inform and advise some of our counterparties around the world, that bodes well. There's definitely a lot of respect given the natural resources and the wealth of resources that we have in Canada, not just in the natural resources, but the people resources as well.
What's on your radar, Shafik?
The main thing I'm looking at is domestically, there's really not much going on. As I mentioned earlier, on Thursday, Mark Carney, the governor of Canada's Bank of Canada governor, is giving a speech at the Canadian Auto Workers Union. I want to take a look at what he has to say and what he's talking about the future of interest rates and monetary policy, because that's going to affect which way the Canadian dollar goes. And
Russ, what's on your radar?
The next 2 months is a very tricky time from the investment world, but like we said, a lot of analysts feel this is the best time since the 50s, but you better know what you're investing in, better be high-quality companies, and if they're not paying a great dividend, you better understand the underlying assets they hold if they can weather the storm that potentially is ahead of us.
Look for those rocks in the ocean. And Beth, last word to you.
Absolutely. Smart investing will prevail, so be careful, be selective. Just because it's a tech stock doesn't mean it's going to win, and we've certainly seen that this week between Facebook and Apple.
Thank you very much. Another enjoyable Monday night. Russell Dratwa is an investment advisor with Canaccord Wealth Management. In Calgary, Shafik Hirani is a director with Investors Group Calgary. And Beth Hamilton-Keene is director and portfolio manager of More Investment Management in Calgary.